Warren Buffett just made the biggest bet of his career, and it's not what you think. The Oracle of Omaha is sitting on a record-breaking $348 billion in cash. That's more money than Apple, Amazon, Google, and Microsoft have combined. More than enough to buy every NFL and NBA team with $34 billion left over. This isn't just cautious investing. This is preparation for something big. And the first quarter of 2025 proved he was right to be worried. Buffett built his fortune by buying great companies and holding them forever. But in 2024, he did something completely out of character. He sold $134 billion worth of stocks in just 9 months. He dumped 2/3 of his Apple position, worth $117 billion. He trimmed a massive chunk of Bank of America, over 1/3 of his position. Companies he once called the best businesses in the world. Why would the world's greatest long-term investor suddenly become a seller? The answer isn't just about overvalued markets. It's about understanding that we're entering the 2025 market reset, a period of economic disruption that smart money saw coming from miles away. Today, I'm breaking down exactly why Buffett is hoarding cash, what the current market turmoil really means, and most importantly, how you can position yourself to profit from this reset instead of becoming another casualty. So, what's really happening in 2025? The market didn't crash by accident. 3 major forces converged to create perfect storm conditions, and Buffett positioned himself ahead of all of them. First, we have the tariff shock. President Trump's tariffs went into effect in April, imposing 10% baseline tariffs on virtually every trading partner. But that was just the beginning. By August, we're seeing tariffs as high as 25% on some countries. Second, we have economic policy uncertainty. The EPU index doubled from January to March, reaching its highest point since COVID. When businesses can't predict policy changes, they stop investing and hiring. Construction spending has dropped 2.9% over the past year. Third, markets were already historically overvalued. Using Buffett's own favorite metric, the ratio of total market value to GDP, stocks hit an all-time high of 209%. That's higher than the 1929 market peak and far above the 140% we saw before the dot-com crash. Buffett saw all of this coming. While everyone else was celebrating record highs, he was quietly building the largest cash position in Berkshire's history. So here's how Buffett positioned himself for the 2025 reset and what you can learn from his playbook. Number 1. Cash have cash. Buffett didn't just pile up cash for no reason. He created a stronghold of liquidity, a kind of financial fortress that works in his favor in several important ways. First off, having cash gives you options. When the market tanks and everyone else is scrambling to sell at bargain prices, cash lets you swoop in and pick up high-quality assets on the cheap. It's like having the ultimate power move when others are stuck. But Buffett's cash isn't just sitting around gathering dust. Most of it is parked in U.S. Treasury bills, earning about 5%, which means that huge pile of money around $348 billion is quietly bringing in roughly $17 billion a year without any risk. That's a serious return for basically doing nothing. And there's another important point. Cash acts as a shield. When the market freaks out, investors who use a lot of borrowed money get margin calls and have to sell their best holdings just to cover their debts. Buffett avoids this mess because he barely uses leverage at all. The big takeaway here is simple. When uncertainty hits, having liquid cash on hand is often worth more than chasing higher returns. It gives you freedom, safety, and the chance to act when others can't. Number 2, sell smart. Buffett was very deliberate about what to let go and what to hold on to. He kept his strongest businesses close while stepping back from companies facing clear challenges. Take his move with Apple, for example. Looking back, it makes total sense. Tech companies were getting hit hard by tariffs, especially those relying on manufacturing in China. When Trump announced a full tariff on computer chips, Buffett anticipated the impact and started trimming his Apple stake before most people caught on. Would you ever sell Apple if you owned it? Comment below. He did something similar with Bank of America. Regional banks were under pressure from rising interest rates, risks tied to commercial real estate, and overall economic uncertainty. By cutting back there, Buffett managed to sidestep much of the banking turmoil that followed. But the interesting part is what he held on to. Berkshire's own businesses like BNSF Railroad, Berkshire Hathaway Energy, and GEICO. These companies bring in steady, reliable cash no matter what's happening with the stock market, giving Buffett a solid foundation even when things get rocky. Number 3. Have patience. Yes. Perhaps most importantly, Buffett demonstrated the power of patience. In his February letter to shareholders, he made it clear. Even though he's holding a lot of cash right now, the vast majority of his money is still invested in stocks, and that's not going to change. This wasn't about trying to time the market or make a quick guess. It was a smart, long-term strategy. Buffett understands that times of uncertainty are actually the best moments to find great bargains. Instead of freaking out over the market's ups and downs, he was getting ready to seize those chances. And the payoff? It's hard to argue with results. While the S&P 500 dropped 11% in 2025, Berkshire Hathaway's stock climbed more than 12%. By staying patient and holding cash when others were caught up in excitement, Buffett set himself up to come out ahead once reality kicked back in. So that's what Buffett did. But what about you? What steps can you take right now? First, build your own emergency fortress. This means having 6 to 12 months worth of living expenses set aside in cash or something just as safe. No stocks, no crypto, nothing that swings wildly in value. This isn't just about being prepared for emergencies, it's about being ready to jump on opportunities when the market takes a hit. Because the next crash will come, and when it does, you want to be the buyer, not the one forced to sell. Next, practice selective patience. You don't have to sell everything in panic like some doomsday prepper. Instead, take a careful look at your investments. Which ones can stand strong during economic uncertainty? Which might struggle because of policy changes or other challenges? It's smart to think about trimming exposure to highly leveraged companies, businesses heavily reliant on global trade, or those speculative growth stocks that are priced way too high. Hold on to companies with solid balance sheets, steady cash flows, and real pricing power. Also, think in decades, not quarters. Buffett's real skill isn't guessing the market's short-term moves. It's about understanding true long-term value and having the patience to wait for the right moment. The current uncertainty won't last forever. Eventually, policies will settle, markets will stabilize, and growth will pick back up. The companies that make it through this transition are the ones worth owning for years to come. Finally, don't overlook the dividend safety net. In shaky times, stocks that pay reliable dividends become even more valuable. Companies that keep raising their dividends through tough economic stretches show they're built to last. Look for rare companies that have increased their dividends for 25 years or more. They've proven they can weather any storm while rewarding shareholders along the way. Now, welcome back to the Muchafy bonus moment, where we share the insight that could change your financial future. Here's the most important lesson from Buffett's 2025 positioning that nobody is talking about. Success in investing isn't about being right all the time. It's about being prepared for when you're wrong and positioned to capitalize when you're right. Buffett didn't know exactly when markets would stumble or exactly how the tariff situation would unfold. But he knew that when you're dealing with historically high valuations and increasing policy uncertainty, the risk-reward equation favors caution. See? The goal isn't to maximize returns in any single year. The goal is to avoid permanent loss of capital while positioning for long-term wealth creation. The next few quarters will likely bring more volatility, more uncertainty, and more opportunities for those prepared to act. The question is, will you be ready to buy when others are forced to sell? Well, at least you will be if you hit that like button and subscribe with notifications turned on. Remember, simplify money, Muchafy wealth, one smart decision at a time.